Welcome to Central Kentucky Community Foundation's 2021 Investment and Economic Outlook Briefing. Unfortunately, due to a recording glitch, the video did not record CKCF's President and CEO Devette Sweeney's introduction, but you will be able to view the economic insights from Augustine Faucher, Chief Economist with PNC Institutional Investment Group. The video begins with Mark Schneider, Vice President and Senior Investment Advisor with PNC Institutional Asset Management, who introduces Gus. We hope you enjoy the recording.
20%. So that's a 13.5% difference between the top two asset classes in regards to performance for the year, which is almost really unheard of, in recent memory. As an example, large cap value stocks had a return of 1.4%. So growth significantly outperformed value, and that trend, as we've seen the last several years. And all asset classes and general asset classes were positive except for REITs. And they were the only negative sector, down about 5% in 2020. Core bonds were up about 0.5%. So we saw kind of broad performance, but we really had significant kind of outlier performance in various parts of the year. So for the first 3 quarters of 2020, especially in domestic large cap stocks, about 5 or 6 companies called the FANG stocks, Facebook, Amazon, Apple, Netflix, Google, and also Microsoft, throw them in there. For the first 3 quarters of the year, those 6 companies returned almost 9%. And every other stock, the 495 companies approximately in S&P 500, were down 3% during those 3 quarters of 2020. So all, those handful of stocks now comprise over 20% of the S&P 500. Just kind of shows you the magnitude of that stay-at-home trade and what was driving the markets. But in the fourth quarter, when we started to see some positive developments around vaccines and get the election behind us, and potential additional stimulus, we saw broad market exposure and really a reversal of that. So large cap value type companies outperformed growth companies in the fourth quarter, more broad-based returns. So that group of 6 stocks returned 2.2% in the quarter, and everything else was almost 10%. So that kind of gets the S&P 500 to about 18.3% for the year. 12% of that was from those 6 stocks, and about 6% was everything else. So if you really had allocations in those 6 stocks, you had trouble kind of outperforming or staying with the markets. The equity fund for the Central Kentucky Community Foundation had a total return of 18.3% for the year. Strong performance, and who would have thought that type of performance with everything we went through that Gus is going to talk about and also look forward. And the fixed income, and that equity fund is about $21.1 million at the end of the year. The fixed income fund, about $7.6 million, had a return of 8.7%. So strong performance in the fixed income. A lot of that was in the first quarter, and really the same type of outlier performance there as well. That if you held anything other than long government bonds in the first quarter, you underperformed significantly. But when the Fed stepped in, kind of stabilized the fixed income markets, from that point forward, the rest of the remaining 3 quarters of the year, credit really took over, and our credit allocations dug out of that hole and had positive outperformance, significantly outperforming the ag. So really what you can get with the Central Kentucky Community Foundation is the ability to invest into mature investment pools in a very efficient way. So you can buy units of these pools to meet your objectives and partner with the foundation. And I think that type of platform, an efficient platform, is key to the growth moving forward. So we do anticipate volatility to continue. We're a little more optimistic in regards to equity performance versus fixed income, where we currently are in this environment. And overall, if we can get the COVID behind us, we'll feel optimistic. And I'm gonna let Gus kind of talk about where we are there. And so I'm pleased to introduce again Gus Faucher, our Chief Economist for PNC. He's been with us the last couple of years, and interestingly, last year was with us for our last meeting right before, a couple weeks before the economy shut down. So Gus has been with PNC, since 2011, and now as our chief economist. He was previously worked with Moody's Analytics and also with the Treasury Department. Has PhD in economics from the University of Pennsylvania, and with concentrations in labor economics and public economics, and also has a BA in economics from Cornell University. So it's my great pleasure to introduce Gus and back to the Central Kentucky area, and I'll hand it over to Gus for his comments.
All right, well, thank you very much, Mark. I appreciate that. Hopefully my slide should be up on the screen. I'm sorry that I can't be there in person with you this morning. As many of you know, my son goes to, Transylvania University in Lexington. So I always appreciate the opportunity to come to Kentucky and spend time there and see my son, although he's actually taking classes from home right now, given current circumstances. But as Mark mentioned, we're in a very weird place with the U.S. economy right now. I look back on my notes from when I was there in February of 2020, and I am glad to say that I had indeed listed the coronavirus as one of the downside risks to the economic outlook. I think it's fair to say that even when I was in Central Kentucky in 2020, we did not expect things to turn out the way that they did. We officially had a recession, according to the National Bureau for Economic Research, which is a group in the U.S. that dates recessions and expansions in the United States. And that ended what had been the longest expansion in U.S. economic history, more than 10.5 years. And if you remember when I was there last year, I told you that the economic fundamentals of the U.S. economy were good and that we expected that the expansion would continue throughout 2020. The economic fundamentals were good. What happened was something that was external to the economy. The coronavirus pandemic came along, and that's what caused the recession. And that's been very different from other recessions that we've seen in the United States. If we think back to the Great Recession a dozen years or so ago, that was caused by problems in the housing market that spread to the financial system. The recession in the early 2000s, that was caused by the bursting of the tech bubble. The double dip recessions that we had in the early 1980s, those were caused by very high inflation and the Federal Reserve aggressively raising interest rates. This time around, the shock to the economy came from something external, the pandemic, and so it's been very different from other recessions that we've seen in the United States. And it's especially unfortunate because we were seeing quite broad-based economic growth in the last few years of the expansion. This shows median household income. This is half of households earn above this, half of households earn below this, adjusted for inflation, the percent change over the year. You can see that we had very strong median household income growth in 2019. At that point, we had about 10 years of economic expansion. The unemployment rate had moved below 4%. Businesses were competing for workers, and that was causing pay increases that was leading to income growth, not just at the high end, but also in the middle of the economic spectrum and the low end of the economic spectrum. And so we were having that broad-based economic growth in 2018, 2019, into 2020 before the pandemic hit. So it's unfortunate that the pandemic did disrupt the labor market and that broad-based income growth that it was driving. We've seen very aggressive policy response from the Federal Reserve. So this shows both the short-term interest rate, the interest rate on a 3-month Treasury bill, what it costs the federal government to borrow for 3 months, as well as a long-term interest rate, the interest rate on a 10-year U.S. government Treasury bond. You can see that when the pandemic struck, the Federal Reserve cut short-term interest rates, their Fed funds rate, that's their key rate, and that pushed that 3-month Treasury bill rate basically down to zero. So if you lend money to the federal government for 3 months, at the end of those 3 months, you're going to basically get back to the federal government what you initially loaned them. Long-term interest rates fell as well. The Fed pushed short-term rates low. They decided that they needed to do more. They purchased long-term securities. That's put little bit since then, but still very, very low on a historical basis. For example, the 30-year fixed mortgage rate is now below 3%. That's driving a recovery in the housing market and is contributing to the improvement in the economy that we're seeing. And so both short-term and long-term interest rates are extremely low right now, and that is help driving economic activity in the United States. And the stock market has been anticipating a full recovery. As Mark mentioned, we've seen very strong gains in the stock market. The blue bars, the S&P 500, that's a broad measure of stock prices in the U.S. economy. You can see that that fell sharply in the spring of 2020 as the pandemic hit. Stock prices fell by about 1/3 from their peak to the trough, but since then we've seen big increases in stock prices, and in fact, we've seen the S&P 500 at a record high in recent days. And stock prices are forward-looking. They're not looking at conditions in February of 2021, but they're looking at the expectations for corporate profits 6, 9, 12 months from now. And I think it is fair to say that the stock market is pricing in continued improvement in the economy, continued improvement in corporate profitability over the next year or two ahead. That being said, if you look at the orange line on the right-hand scale, that's the Vix Index. That's a measure of how much stock prices are moving up and down. Obviously, we had a very big increase in volatility in the stock market in early 2020 as the pandemic came to the United States. It has fallen since then, but we've been through a lot over the past year. We've been through the pandemic, we've been through the presidential election and all the turmoil that followed with that, change of control in the Senate, Biden administration's plans for stimulus, all of that. And so we have seen elevated volatility even through the worst of the pandemic. And so I think it is fair to say that even as stock prices continue to move higher, that volatility will also remain elevated, and that we should expect to see continued big swings in stock prices going forward as we get more information on, for example, variations in the coronavirus and concerns about those spreading more rapidly, changing plans for stimulus, problems with vaccine distribution and so forth. And so we will continue to see high volatility until we get a better sense of where the economy and the corporate profits will be going over the next couple of years. The pandemic put about 1/2 of the US economy at risk. So this shows GDP in 2019 before the pandemic. I've excluded imports. And so let's talk about the portions of the economy that are less at risk. First is government, that blue piece, about 17% of the US economy. If anything, we've seen government spending increase in response to the pandemic. Consumer spending on non-durable goods. These are goods meant to last fewer than 3 years, food, clothing, that type of thing. The orange portion, 14% of the US economy. People continue to spend on that. Consumer spending on healthcare, housing, and utilities. The green portion, that's about 1/5 of the US economy. As you all well know, to this morning in Kentucky, you still need to heat your home. You still need to pay your rent. You still need to go to the physician or to the dentist. So that's less subject to the pandemic. But there are big parts of the economy that are more subject to the pandemic. So others spending on other consumer services, the kind of lighter orange, that's about 1/4 of the US economy. That's restaurants, that's travel, for example, where we've all cut back. It's what we call personal care services. So that's childcare, dry cleaning, those types of things, entertainment. That's about, that's 1/4 of the US economy, and that has taken a huge hit because of the pandemic. Consumer spending on durables, the yellow portion, and this is a big industry for Kentucky because of its car manufacturing facilities. That's about 7% of the US economy. It's easier for consumers to cut back on buying appliances or buying new cars if they're concerned about the outlook. Investment, fixed investment, that includes both investment in housing, as well as business fixed investment. So that is business investment in information technology and equipment and structures. Commercial construction has taken a big hit. That's about 18% of the US economy, and that really suffered during the pandemic. And then finally, exports, the black portion, it's about 12% of the US economy. The pandemic has been global in nature, and so we've seen big declines in US exports because of the global pandemic. And so about half of the US economy took a real big hit in 2020. And in fact, we saw an unprecedented contraction in economic activity in the first half of last year. So this shows 3 measures of economic activity, the percent change from 1 year ago. This isn't just adjusted for price changes. GDP, the blue line, that is output of goods and services. That's the broadest measure of the US economy that we have. What we call final sales of domestic product, that's GDP minus the change in inventories. Sorry, my dog's barking and it's a little bit distracting. Sorry about that. That measures demand for goods and services produced in the United States, whether they're consumed here or abroad. And then finally, what we call gross domestic income. That's the income going to businesses and in households from economic activity, so it excludes transfer payments. But you can see that all of those declined at an unprecedented pace in the first half of 2020. Basically, in the second quarter of 2020, the US economy was about 10% smaller than it had been in the fourth quarter of 2019. We were producing about 10% fewer goods and services than we had been just 6 months earlier. To put that in context, during the Great Recession, we saw real GDP decline by about 4% over a period of 6 quarters. So this was a much steeper decline in economic activity over a much, much shorter period of time, and simply unprecedented economic dislocation. And we can see that in a lot of measures of economic activity. That being said, however, we have seen a big pickup in economic activity since April. So the blue bars show the change between February and April. The orange bars show the change between February and December. So for example, food service, restaurants, those sales fell by 55% in 2 months. Okay, now they have come back since then. In fact, we just got data on this morning, and I didn't have time to incorporate it. We did have an improvement in a pretty substantial improvement in restaurant sales in January, but they're still down 15, 16% from where they were before the pandemic. But other industries have fared a lot better. Auto sales, again, an important industry for Kentucky, those fell by about 1/2 between February and April as dealerships closed. They're now basically back to their pre-pandemic level, in large part because of very low interest rates and financing costs. Housing starts, those fell by 40% from February to April as construction sites closed. They're now above their pre-pandemic level. Again, very low mortgage rates are supporting the housing market. Existing home sales, look what happened there. Those fell by about 1/4 over 2 months. They're now about 16, 17% above their pre-pandemic level. People want to purchase a new home. Mortgage rates are low. Affordability is good. So that's driving economic activity. Industrial production, output of manufacturers, mines, and utilities. In fact, we got new data on this about 6 or 7 minutes ago. I don't know what it says. You can see that we had a big drop in activity there, but basically now back to its pre-pandemic level. And I would not be surprised when I do incorporate the January numbers if they're actually back to where they were before February. Consumer spending, excluding food, restaurant sales, autos, and gasoline. So this is broad consumer spending. That fell by about 12% initially, is now up about 5% from before the pre-recession peak. Food and beverage sales, those dropped by about 10% initially. I'm sorry. This is grocery store sales. Those actually jumped in the pandemic. I'm sure, like many of you, we were cooking at home more, going out to restaurants a lot less. So we saw a big jump in grocery store sales. And then finally, this is key, that those bars down at the bottom, nominal after-tax household income. So that is the income going to households, whether it's from investments, whether it's from the labor market, and the big portion here is transfer payments from the federal government. You can see that jumped between February and April. We saw household income actually increase by about 13% between February and April. This is at a time when the US economy was losing 22 million jobs. What was going on? Well, we had those stimulus payments that were sent out to households. We made more people eligible for unemployment insurance, gig workers like Uber and Lyft drivers, the self-employed independent contractors, and we increased the level of unemployment insurance benefits. Many people were getting an extra $600 a week in unemployment insurance. So we actually saw household income increase in the face of a huge economic downturn. And that's simply unprecedented, and that's what's allowed households to actually increase spending in many areas of the economy, despite all the dislocation that we saw because of the pandemic. Now, the benefit of those stimulus checks has faded, although people did get more stimulus checks in January, so we'll see another boost. But household income is still above where it was prior to the pandemic, and that's allowing consumers to continue to spend. We did see huge problems in the US labor market. We lost 22 million jobs between February and April. To put that in context, during the Great Recession, we lost 8 million jobs over 2 years. So much larger job losses in a very, very concentrated period. You can see that we initially had a very rapid rebound in employment as businesses reopened and rehired workers who've been laid off temporarily. But over the past few months, we've basically seen flat employment, and we're still stuck down about 10 million jobs from where we were before the pandemic. That takes us only back to 2015 employment levels. And so certainly the labor market has a very deep hole to dig itself out of. And I think this chart shows pretty well the unprecedented nature of the disruption to the US labor market. This is the employment to population ratio. This is the share of adults 16 and over who were working. You can see that that was about 61, 62% in February before the pandemic. That fell to about 51% in April. That's the lowest in history. This data goes back to just after World War II. We'd never seen that small a share of adults working, back up to 57% or so as of January, but that only takes us back to 1970s levels. You think about all the big changes we've had in the US labor market since then. Entrance of the baby boomers into much larger numbers, entrance of women into the labor market in much larger numbers. And so, we right now have about 3.5% of the US population that was working before the pandemic that is not working now. And I think that demonstrates the enormous hole that the labor market still has to dig itself out of. The good news is that I think that consumer spending growth will be quite solid throughout 2021 into 2022. Big reason why is that households have a lot more cash on hand. So the blue line on the left-hand scale, that is the personal savings rate. That is the household saving as a share of after-tax income. Even before the pandemic, so in late 2019, the household savings rate was still about 7%. That was well above the 3.5–4% rate we had going into the Great Recession. So households throughout the expansion had been saving more than they had been during the recession. And so they had more going in. And then you can see that enormous spike in the personal savings rate in 2020. What happened there? Well, when the worst of the pandemic hit, households weren't going out. They weren't spending money on restaurants, on travel, that type of thing. At the same point, their income rose, right? Because of that, because of the increase in transfer payments. And so we saw a huge increase in the household savings rate. Now it's fallen somewhat since then, but it's still well above its long run average. And so households do have a lot of cash on hand. And I expect that the personal savings rate will increase in the first quarter with those additional stimulus checks that households receive. Similarly, if you look at the financial obligations ratio, that's the orange line on the right-hand scale. That is mortgage payments, it's rents for renters, credit card payments, student loan payments, auto loans and leases, property taxes, homeowners insurance, those types of payments that households make on a regular basis. You can see that that financial obligations ratio again, was very low even before the pandemic. Households had refinanced their debt, they'd paid off their loans, much lower than it was heading into the financial crisis where households had taken on a lot of debt, particularly housing debt. And then it plunged. Again, households paid off their credit cards when they got their stimulus payments, they refinanced their mortgages, and they had more income because of those transfer payments. And so the financial obligations ratio is now near a record low. So households have very low debt levels that will allow them to gradually increase their spending going forward. Business debt is a little bit more of a concern. If you look at non-financial corporate debt as a share of the size of the economy, the blue line on the left-hand scale, you can see that even before the pandemic, that was at an all-time high. Businesses had taken on a lot of debt. And then it jumped up in the pandemic as businesses got Paycheck Protection Program loans, or as they drew down on their lines of credit to make sure they had enough cash to get through the pandemic. On the other hand, if you look at interest payments as a share of cash flow for non-financial corporations. That's really low right now, near historic lows. What's going on there? Well, interest rates are exceedingly low right now. So businesses, although they do have a lot of debt, their financing costs are very low. And so we are watching corporate debt, but we do not think at this point that the level of corporate debt, the level of interest payments represents a threat to the economic recovery that is underway right now. We've gotten $3 trillion in stimulus. And so the big portions, you can see small business loans and grants. This includes the stimulus package that was passed at the end of 2020 and that President Trump signed into law. So more than $1 trillion in aid to small and medium-sized businesses. That's primarily the Paycheck Protection Program. And so that made very low interest loans to small and medium-sized businesses. Those loans will turn into grants if those businesses meet certain requirements in terms of maintaining payrolls and maintaining pay levels. I'm on the board of directors of a nonprofit here in Pittsburgh, and we're in the process of applying for forgiveness from the PPP loan. Perhaps some of the nonprofits that you work with, they may be applying for PPP forgiveness as well. But that has been enormous support for many small and medium-sized businesses. We've also had aid for big businesses, primarily the airlines. Those stimulus payments, more than $400 billion in payments to households. And again, this includes the payments that many households received at the end of 2020 or beginning of 2021, and almost $400 billion in aid to the unemployed. And so that has made a huge difference for the recovery and has really allowed that growth that we have seen in the U.S. economy since the worst of the pandemic in the late winter, early spring of 2020 has allowed for that recovery that is underway. And that Paycheck Protection Program has been very, very important. We do a small business survey every 6 months. This is the results from our fall 2020 survey. We'll have our spring survey results released, I think at the beginning of March is the plan right now. But the firms that we interviewed that had applied for a PPP loan, 69% said it was extremely important to their business, and another 28% said it was somewhat important. So those Paycheck Protection Program loans, grants have been extremely valuable to small and medium-sized businesses and have allowed them to get through the economic recovery. That being said, the businesses that we surveyed still do need support. So of the businesses that we surveyed, 1/3 said that additional stimulus funding was extremely important. 22% said it was somewhat important. Now, this was before we got the stimulus package at the end of 2020, but certainly businesses were concerned about the economic environment. The federal government right now should not be concerned about spending too much. I'm much more concerned about the federal government spending too little than spending too much right now. Yes, we have seen a huge increase in the federal government's budget deficit, the difference between outlays, spending, the blue line, and revenues, tax revenues, the orange line. But don't forget, borrowing costs are extremely low right now. Even with all the borrowing that the federal government did in 2020, its total interest costs declined because of very low interest rates. And so I would much rather the federal government err on the side of too much stimulus than too little stimulus. We still face challenges over the longer run in terms of funding retirement for the baby boomers through Social Security and Medicare, figuring out how to pay for national defense, infrastructure investment, all of that. But it will be a lot easier to do that from a position of strength rather than a weak economy. So I think we should be spending now to invest in a strong economic recovery. And then over the longer run, we can figure out how to address our nation's long-term fiscal challenges. And 1/3 of small and medium-sized businesses are still at risk. This is again from our survey. 1/3 said that they could not last a year under current economic conditions. And it would be a real shame to have a lot of these small and medium-sized businesses fail in the short run when they're viable over the longer run. Because if they fail in the short run, That means that it takes time for new businesses to rise up and take their place. That means a slower recovery. It could mean slower long-run economic growth, less innovation, that type of thing. And so it'd be very unfortunate if we let fiscal concerns in the near term prevent us from having stronger long-run economic growth. We've seen a very aggressive action from the Federal Reserve, as I mentioned. So we've seen the Fed cut short-term interest rates. They've also cut long-term interest rates by purchasing longer-term treasuries. Those are the orange bars here. You can see that big jump up in 2020, as well as purchasing mortgage-backed securities. And that's a push that 30-year fixed mortgage rate below 3%. And so the Federal Reserve has been extremely aggressive, and those low interest rates have made a huge difference for the U.S. economy. And I'm not terribly concerned about the potential for this to lead to higher inflation. The Federal Reserve has set an inflation objective. They want inflation to average 2% over a period of years. Inflation has been well below that for most of the past decade. And financial markets don't expect inflation to move much higher. So this is what we call five-year forward inflation expectations. This is what financial markets think inflation will be 5 years to 10 years from now. This is based on the difference in interest rates between a regular treasury bond that pays a regular rate of interest, and then what we call inflation-protected securities, which are treasuries which pay a rate of the rate of inflation over its period, plus a rate of interest on top of that. And you can use that to back out what financial markets think inflation will be. And so basically from 2026 to 2031, financial markets expect inflation is just going to average a little bit more than 2%. Inflation is low. It's difficult for many businesses to raise prices in the current environment. The unemployment rate remains elevated. And so I just don't see inflation as being a significant problem, even with all the stimulus that the economy is getting from the Federal Reserve, from the federal government. So there's a huge amount of uncertainty out there. And so here is what I'm pretty sure is going on right now. So that the U.S. economy did have a very steep recession in 2020, but that a recovery started in mid-2020. Now, recovery doesn't mean that the economy is good. It just means that the economy is better than it was during the recession. So we've seen employment increase, we've seen output increase, we've seen consumer spending increase, so that we are in a recovery right now. The unemployment rate, which was 3.5% in February, jumped to almost 15% in April. It was down to 6.3% as of January of this year. So it's fallen dramatically, but still well above where it was before the pandemic. I do expect that inflation will remain low, as I mentioned. I just think it's very difficult for businesses to raise prices in the current environment, and that we are going to see some structural shifts in the U.S. economy. I think that we've seen a big change in the retail industry. So even before the pandemic, traditional retailing was losing ground to online sales like Amazon. That process intensified with the pandemic, and we're not going to reverse that online sales will continue to grow at the expense of traditional retailing. We've seen businesses reconfigure their supply chain, so they're keeping more inventory on hand. We're seeing the problems in supply chains in the auto industry, for example, with the shortage of semiconductors from abroad because of the disruption from the pandemic. And so we may see businesses start to source more from within the United States rather than from abroad, so that there's fewer problems with supply chains in other emergencies going forward. And then I do think that we'll see big changes in commercial real estate markets. Even before the pandemic, retail real estate was really suffering. I think it's taken a further hit with the pandemic. I think that we have too much retail space, and we're going to need to restructure that. Office space, I'm less certain about what's going to happen there. A lot of businesses still want to move back to the office. I've been out of the office since March. We may get back at the end of March. We'll see how that goes. But commercial real estate markets, I think that office markets, perhaps we have a structurally lower need for office space going forward, and then we'll need to repurpose that space. So it'll be interesting to see how that plays out. Here's what I'm less sure about. So the shape of the recovery this year, are we going to see a very strong V-shaped recovery? Are we going to see a more gradual U-shaped or even a Nike swoosh with very weak growth? It's possible. I think it's less likely now, but it's possible that if the pandemic re-intensifies, that we could actually see the economy contract again at some point in 2021. Perhaps if there are problems with vaccines, if these new variations of the coronavirus lead to further government restrictions. So I'm not saying that is going to happen, but that potential is still out there. How effective the Paycheck Protection Program is at preventing business failures. The more permanent business failures that we see, the slower the recovery, the greater the long run damage to the economy. How much stimulus we're going to get. The Biden administration is pushing for a $1.9 billion stimulus. Excuse me, $1.9 trillion stimulus. We'll see what happens there. But I do think that more stimulus is helpful and that it's much better to err on the side of too much stimulus rather than too little stimulus. How quickly the unemployment rate falls. We've seen a big initial improvement in the labor market, but I do think that the jobs recovery is going to be slower going forward. The longer run impact on economic growth. Has the pandemic caused permanent damage to the U.S. economy that will lead to slower long run economic growth? And then finally, the impact on the housing market. We've seen a big increase in housing starts and existing home sales, as I pointed out. Maybe this is a permanent shift and people want to move out of cities into the suburbs. Maybe they want to move out of apartments into single family homes, or maybe this is just temporary, that if the pandemic recedes, as we get more vaccine distribution, that, people will start to reconsider that and decide that they really do want to live in cities and live in apartments. So we'll have to see how that plays out. What matters is the public health response, vaccine distribution. So we really need to make sure that we do an effective job of distributing the vaccine so that people feel comfortable going out. How much more stimulus? Go big or go home. I think that there are three areas that stimulus should focus on. First is additional aid to small and medium-sized businesses so that we avoid many of those business failures of businesses that would be viable over the longer run. Second part is aid to households to make sure that households, particularly those that have been most impacted by the pandemic with unemployed workers, can maintain their spending. And then the third is aid to state and local governments. I think that state and local governments, many of them are under pressure because of reduced sales tax revenues, personal income tax revenues. And so many of them will have budget holes that they will need to fill. And I'm concerned that state and local job cuts, spending cuts in the second half of 2021 and 2022 could really slow the recovery. And then again, business assistance. We need to aid those small and medium-sized businesses so that we don't have those permanent business failures that cause problems throughout the economy. So here's our forecast. So blue line is real GDP. You can see the enormous decline that we had in the first half of 2020. I do expect first quarter is actually looking okay, particularly with those strong consumer spending numbers that we got. I think we'll have a very strong 2021, slower growth in 2022, but a significant improvement in the economy over the next couple of years, particularly if we get more stimulus from the Biden administration. Unemployment rate, which peaked at close to 15% on a monthly basis in April, down to a little bit above 6% in early 2021. I think it'll end this year a little bit below 6% and then 2022 at around 5% or so. So significant improvement in the jobs market, but still, even after a couple of years, I think the unemployment rate is going to remain well above its pre-pandemic level of 3.5%. And it is going to take a long time, particularly for some measures of economic activity, to make up lost ground. So real GDP, I think, will reach a new peak there by the end of this year. Business fixed investment. That's actually been very strong, supported by low interest rates. Businesses, are reconfiguring to address the pandemic. I think that, we'll see, that is going to be very strong over the next few years. But I do think employment is going to lag. typically jobs recover more slowly than the economy. So I would not expect to reach a new peak in employment until 2023 or 2024. Similarly, industrial production. I think that we are going to see some slower growth there. And so I think that that recovery there is going to lag. And then finally, housing starts. That's been very strong. I think that housing starts will actually be above their pre-pandemic level throughout 2021, 2022, in part because of those extremely low mortgage rates that we're seeing. And I do think that housing is going to lead the overall economic recovery over the next couple of years. Let's look at regional conditions. So this is the Philadelphia Fed's February 2020 coincident index. So this is how state economies were doing at the beginning of 2020, before the pandemic. You can see that generally economic conditions were pretty solid. Most states were in that green expansion category. Some states were doing better than others, but generally solid economic growth. And you can see that Kentucky was right in the middle of the pack. Go forward to May of 2020, not a lot of positives to take out of this. Every state was seeing a very severe economic contraction. This is very different from most recessions in the United States. Usually there are pockets of the US that are doing well, even during national downturns. That was not the case this time around. We saw a very severe nationwide economic downturn in the spring of 2020. This is their latest index as of December. You can see that Kentucky's looking a little bit weaker. To be honest with you, I'm not quite sure what's going on there. The state should be benefiting from the recovery in auto sales, and you can see other auto producing states are doing well. It might be tied to some weakness in the housing market, but generally conditions are solid, and that we do see expansion in most of the United States as of the end of 2020. Let's take a particular look at Kentucky and central Kentucky. This is employment. I set the peak in 2020 before the pandemic equal to 100. We have the US in blue, we have Kentucky in green, and then the Elizabethtown Fort Knox metro area in orange. You can see that, actually Elizabethtown Fort Knox had been doing a little bit better than the rest of Kentucky through most of the previous expansion. So strong recovery there. You can see that, job losses in Kentucky weren't quite as severe as they were in the rest of the US. In part, that was because restrictions in Kentucky weren't quite as severe as what we saw in other parts of the United States. Now, I think it is fair to say that, Kentucky has done a little better than the US during the recovery, but central Kentucky's done a little bit worse. Now, the data are jumpy. We'll probably get revisions that may show an improvement there, but the area has done a little bit worse. Not quite sure what's going on there. I think the industrial mix is generally, of the area is generally less exposed to the downturn, in part because of government employment in the area. So we'll have to see how things play out there. The good news, however, is that there's much less exposure to industries that may be subject to long-term restructuring. So this shows the share of employment in oil and gas, air transportation, and leisure hospitality services. And you can see that Kentucky in general, central Kentucky, have a much lower exposure than other parts of the United States. And so that does mean that there will be less long-term economic restructuring in central Kentucky, and that does bode well for growth, over the next 5-10 years or so. And then finally, this is population, you can see that population growth in central Kentucky is much more volatile, swings. A lot of it's tied to military restructuring, that kind of thing. But generally, for the past 4 or 5 years, population growth has been above the Kentucky average, and in fact, above the US national average. And that's what businesses are looking for. They're looking for a growing population, more consumers, more potential workers. And so this certainly does bode well for long-run economic expansion in central Kentucky. So I think I sent, you should have our US write-up for January. That was included as part of the package. We'll be doing our February write-up over the next week or so. You can find that at pnc.com/economic reports. And you can follow me on Twitter at Gus Faucher PNC. With that, thank you very much for your time. And I believe we do have time for some questions. So I would be happy to answer any questions.
if you have questions for Gus, unmute and go ahead and ask your question, or if I notice you unmuting, I'll try to call on you.
Or I think, is there a chat box that people can use as well?
There is a chat. You can type question in the chat as well. We'll read them out.
Oh, we did. There's. Oh. No questions this morning?
No questions for Gus? I'll tell you what you were
Javette,
talking.
can you hear me?
Yes.
This is Bill Seifert from PNC. Just wanted to thank Gus. Wonderful job. But I did have a question. So we have noticed a very recent run up in interest rates. I know you spoke about mortgage rates earlier. Is there anything going on here that we should be concerned about? Is this just normal gyrations in the marketplace? Because it's resulted in some fairly significant price movements because rates were already so low. But just interested in your thoughts there. And it's also resulted in a really positive move in all the financial stocks. So we're watching this closely, but just wanted to get your thoughts.
Yeah, no, I think, first of all, I think that the increase in interest rates is a good sign. It means that investors expect that economic growth is going to be stronger in the years ahead, that they think inflation is going to be a bit stronger, not a whole lot stronger in the years ahead. And so that's what's driven up long-term interest rates. But look at that. I mean, what's the 10-year at 1.1, 1.2%? Very, very low on a historical basis. Think back to where we were before the pandemic. We had the 10-year treasury at a little bit below 2%. So still very, very low on a historical basis. And then the other thing is the Fed does have tools. If the Fed is concerned that interest rates are moving up too quickly, there are things that they can do to help push back down on longer term interest rates. They have been extremely aggressive. They have said that they will be extremely aggressive going forward, and that if they start to get concerned that long-term interest rates are restricting growth, then they have the tools, they have the wherewithal, they have the fortitude to push back against that. So it's a positive sign, and if it gets to be too much of a concern, the Fed can start to push back against that.
Good, thank you.
Other questions for Gus?
Hey Gus, Kevin Blair from PNC also. Quick question. You talked about the positive drivers for recovery and some of the risks. Just curious, with the package that Biden and his administration has proposed, it seems like it continually faces delays. So I'm curious, if it is delayed much longer, how big of a negative impact may that be? And then the second part of that is it appears that the minimum wage component likely will not be able to be included in it. Does that have a negative impact or any impact on your outlook for recovery?
So I mean, it's February, It's February 17th, so we're less than a month into the Biden administration. I mean, I was not expecting a big package to be passed in the first month. I think they are making progress. I would expect to see a package within the next couple of months. We did have that package that was passed at the end of December, and we can see the positive impact of that in January retail sales this morning. If it's another couple months, is that a big deal? No. If it's, if we're at this point in the fall of 2021 and we don't have a package, then I start to get more concerned. But I don't think the delays that we've seen so far represent a real threat to the recovery, particularly given that, we are starting to get the vaccine, and that will, as distribution there continues, as people feel more comfortable going out, that's going to be a big positive. So I think that there is certainly enough momentum in the economy to continue to push things forward, that a stimulus package will be a big help there, but it's not essential that we get it done in the next 3 weeks or something like that. In terms of the minimum wage, there are positive and negatives for minimum wage. For one, it would drive up income for particularly low-income households, people who are lower down on the wage distribution, and that will give them more money to spend. On the other hand, it is going to increase costs for businesses. We might expect it to have a small unemployment effect. it would weigh on job growth slightly. The economic evidence suggests that there's a slight negative impact of a higher minimum wage. But we would expect that it would be phased in over a period of years anyway. It's not going to immediately jump up to 15% on July 1st of 2021. It's going to be, it's going to be a long-term process over a period of 4 or 5 years. And so, I have not built anything into my forecast on a minimum wage. But I don't think that that is a game changer for the recovery one way or another. And also, let me add that I think the impact of a higher minimum wage on inflation would be minimal. And don't forget that the Fed still wants to see a bit higher inflation, so they might actually welcome that.
Hey guys, this is Mark Snyder, and just curious if you see anything settling down in regard to trade relations or any issues in regards to trade and that type of thing, how it might affect economic growth and that type of thing. I know there seems to be a lot of backlog in several areas. I know this as a simple example. We been looking at a little furniture and stuff, and like to get a couch, they were saying it might be May before it's delivered, and that type of thing. I mean, do you see any type of trade issues or things working through that could affect the economic outlook?
Yeah, I think first of all, obviously the pandemic itself has disrupted trade flows. So even getting away from, the political situation, we've seen big disruptions throughout the globe. And so that's really disrupted trade flows. That's weighed on imports, that's weighed on exports. I do expect that a Biden administration will be less confrontational around trade, particularly with Europe. I think that there's a sense that the Biden administration would like better relations with Europe. And so I would expect better trade relations with Europe, with Canada, with Mexico under a Biden administration. China, I'm not so sure about. I think the Biden administration has some of the same concerns about protectionism that the Trump administration had. I think that the Biden administration may push back on China on human rights issues. And so I would not expect to see, conditions in terms of China significantly improve in a Biden administration relative to a Trump administration. And then I would finally point out, as I mentioned, the pandemic has been a big disruptor, but we have seen even before the pandemic, nations were turning inward. We saw that in the United States with the election of President Trump. We've seen that in the UK with Brexit. And so I think that there generally has been a movement away globally, or let me rephrase that. There's been a movement towards, more nationalism, more inward looking. And it's unclear to me that, a Biden administration can significantly change that given its global nature. So I think trade flows will improve, but I'm not sure the trade situation will revert back to where it was under the Obama administration for a number of reasons. And as I mentioned earlier, I think a lot of U.S. companies have seen disruptions in inputs from abroad, and so they may be looking to source more from within the United States.
Well, if we don't have any more questions right now, we'll wrap up. We've gone nearly an hour and appreciate our folks at PNC bringing this outlook to us. Gus, I'll say that while you were speaking a few minutes ago, I saw the sunshine out over my backyard. So hopefully some other folks in our area are getting a little sunshine, and you've definitely brought some light to the situations and the economy for us that will help us in planning and going forward. Just a couple wrap-up points from the foundation. And as you know, many of you know that over the last year, we gave out about $50,000 in COVID relief grants to nonprofits that were helping meet the needs of people impacted by COVID in our region. We also, just this week, awarded another $15,000 additionally that'll go out for rent and utility assistance. As we know, those are very pressing issues for folks today. So just a little update on our work in that area. But as we move forward into 2021, we're always glad to work with folks who want to give back to our community, and those gifts come in lots of forms, and we're glad to work with people to transform gifts like real estate and those IRA distributions and securities into the difference that you want to make in the community. If you'd like to know anything more about what all we've discussed today or our work in general, you can give us a call at 270-737-8393. email us or visit our website. We'll be making this presentation available out. We'll shoot you an email with these slides and a recording of this. So if you missed any bits and pieces, if like some of us working from home has those occasional distractions where you get interrupted and think, wow, I missed exactly what he said right before that, you'll be able to go back and take a look. But we thank you for your trust in Central Kentucky Community Foundation and your commitment to our community. There's lots of exciting work going on in 2021, and we look forward to sharing it with you over the coming days. Thanks,
Thank
everyone.
you all.
Thanks so much.